companies are rushing to take advantage of some of the lowest borrowing costs in history. So with us this morning is State Street Global Markets senior fixed income strategist, John Herrmann. And according to Bloomberg's data, John is one of the most accurate overall forecasters on the U.S. economy, making him a Bloomberg best. Good morning, John.
Hey, doing, Scarlet.
Let's set the scene a little bit here. There were $90.1 billion in corporate bond sales last month, making it the busiest July on record. How long can this go on for? Are we going to see this continue through the summer into the third quarter or fourth quarter?
You know, we think businesses are really taking advantage of a very favorable environment. We have extremely low rates, and yet at the same time, investors are searching for yield over treasuries. So the investor demand is equally strong. So this is just a very good time for companies to be issuing debt, and they have excellent balance sheets that they're leveraging as well. So it's all working together to just make it a very vigorous corporate calendar right now.
There does seem to be a little bit of a contradiction, though, with the GDP report on Friday pointing to a slower recovery than expected. Lots of talk about a double dip. You have these yields near their lowest and spreads narrowing. What or why does the corporate bond market tell us that the economy is stronger than what the official stats are pointing to?
Well, the market may be saying that, and it may not. I think what the market's saying here is that they're discounting the double dip risk, and they can now see from various Fed officials that if in fact the economy starts gearing towards a double dip, that the Fed's going to come in and act very forcefully, perhaps another round of quantitative easing, and they've even mentioned it'll take the form of Treasury security purchases. That in turn would just set off a massive mortgage refinancing wave, which would then support consumer demand and support business revenues. So I think right now, our baseline view is that we're going to get a growth compression where growth comes in 2%, maybe a little weaker over the next several quarters. And a growth compression is not inconsistent with this strong demand that we're seeing for corporate credit.
Okay, you mentioned mortgage refinancing. A lot of what we're seeing are companies refinancing their own debt, right?
Yes.
So, given what's happened in the last couple of years, could this lead to another crisis? More companies taking on more debt?
No, I wouldn't really put it that way. I would look at it as saying, okay, companies have, at this point, in the first quarter, they had close to all-time record profit margins, bring in lots of cash. Their balance sheets are in excellent shape. Cash on the balance sheets is all-time highs. So our outlook is that businesses are very stable, and we think that's part of why the demand is this strong for corporate credit. So looking forward, it's just really a question of, for growth, it's a question of when businesses will feel confident enough to start spending and start really growing their organizations. And I think that's the real key.
Right, and start hiring. Thank you so much. John Herrmann, State Street Global Markets senior fixed income strategist, joining us there.